Good day, everyone. Um, my name is Dr. Austin, and I'll be taking you through the beginner's course for Refinance Academy. I would advise you to have a notepad nearby where you can write things down. So, we're going to be starting with the introduction to Forex. So, what is Forex? In simple terms, Forex is short for foreign exchange, and it's a financial market that allows one to exchange one currency for another. I give an example here. If you've traveled to another country before, you usually had to find a currency exchange booth at the airport and exchange the money you have in your wallet into the currency of the country that you are currently visiting using the exchange rate. And when you do this, you have essentially participated in Forex, basically. So an exchange rate is basically the relative price of two currencies from two different countries. Now, there are different types of markets. Okay, it's not just the forex markets. There are multiple markets. You have the stock markets. This is a well-known market. Simply involves buying and selling of shares of a company. Okay, that's basically the summary of what the stock market is. Then you have the futures market. The futures market is an auction market in which participants buy and sell commodity and futures contracts for delivery on a specified future date. Then we have the forex market. The forex market facilitates the exchange of one currency for another currency. So currencies are always traded in pairs with many potential combinations available, but only some are very liquid and are actually tradable. Okay. Then we have the options market. It's a market that allows participants to undertake positions in the derivative of an asset. Basically, that's the summary of what the options market is. Then you have the cryptocurrency market, which is a decentralized market that allows the exchange of cryptocurrencies, one cryptocurrency for another cryptocurrency, or for fiat currencies. So why Forex? Why do we choose Forex? Now, the main advantage of trading in the foreign exchange market is that there is minimal investment required. Okay, accounts can often be opened for as little as $100, even $10, and will allow individuals to trade global currencies, index, and commodities. With the forex market, the trader is actually exchanging one currency for another, possibly in an account denominated with yet another currency. Okay, it seems nice, it has low barriers to entry, there's literally very little to no commission, and there's very high leverage. Okay, and you also have free trading tools and charts and research tools as well. So it's very accessible and it's very easy to trade with, okay, when you're in the forex market. So let's move on to currency pairs. So what are currency pairs? Currency pairs are the national currencies from two countries coupled for trading on the foreign exchange marketplace. Both currencies will have exchange rates on which the trade will have its position basis. All trading within the forex market, whether you're selling, buying, or trading, will take place through currency pairs. So an example of a currency pair is Euro USD, which is the euro paired against the United States dollar. And Euro USD is the most liquid pair in the world. That's the most traded pair in the world. Okay, so when you have a currency pair like this, the first currency in a pair is called the base currency, while the second currency is called the quote currency. So in this example now, with this Euro USD example, so this Euro, which is the first currency, is called the base currency, and USD, which is the second currency, is called the quote currency. So there are three types of currency pairs in Forex, and they include one, the major currency pairs, two, minor currency pairs, and three, exotic pairs. And we're going to dive deep into each one of them. So now the major currency pairs, these are pairs that contain the US dollar on one side, either on the base side or on the quote side. So either the base currency is USD or the quote currency is USD. They are the most frequently traded pairs in the forex market. The majors or the major pairs generally have the lowest spread and are the most liquid. Okay, so like I said earlier, the Euro USD is the most traded pair with a daily trade volume of nearly 30% of the entire forex market. Okay, so the major currency pairs include Euro USD, which is Euro against the United States dollar. You have USD JPY, which is United States dollar against Japanese yen. You have GBP USD, which is the Great British Pound against the United States dollar. Then you have the USD CAD, which is the United States dollar against the Canadian dollar. Then you have the USD CHF, USD CHF here, which is the United States dollar against the Swiss franc. And you have AUD USD, which is Australian dollar against United States dollar. And then lastly, you have the NZD USD, which is the New Zealand dollar against the United States dollar. So basically, these are the 7 major currency pairs, and these are the pairs you should focus on as a new trader. If you want to start trading, focus on this particular trade because they are the most liquid pairs and the most traded pairs. So they will not really give you issues when you're trading them. Next, we have the minor currency pairs. So the minor currency pairs are currency pairs that do not contain the US dollar. They are known as minor currency pairs or cross currency pairs. Okay, and they include pairs like Euro GBP, which is Euro versus the Great British Pound. You have Euro CHF, which is Euro against the Swiss franc. You have Euro CAD, which is the Euro against Canadian dollar. You have Euro AUD, which is Euro against the Australian dollar. You have Euro NZD, which is Euro against the New Zealand dollar, and you have Euro JPY, which is Euro against Japanese yen. There are more minor currency pairs. I couldn't list all of them, but there are so many others. There are different crosses of these pairs. So we'll talk about more. We'll talk more about that in the mentorship. But at least just know that the minor currency pairs do not contain the US dollar. Okay. Okay, see more examples of minor currency pairs here. You have the GBP JPY, CHF JPY, CAD JPY, AUD JPY, NZD JPY, GBP CHF, GBP AUD, and GBP CAD. There are so many others. Okay. Next, we have the exotic currency pairs. The exotic currency pairs are made up of a major currency pair with the currency of an emerging or a strong but smaller economy from a global perspective. Okay, so these pairs are not traded as often as the majors or minors. So they often, the cost of trading these pairs can be higher than the majors or minors due to lack of liquidities. Okay, so the exotic pairs, some examples of exotic pairs are USD TRY, which is euro against the Turkish lira, USD SEK, USD NOK, USD DKK, USD ZAR. USD ZAR is US dollar against the South African rand, and so much more. That's where Nigerian naira comes in as well. If you have things like USD against Nigerian naira, that's also an exotic pair. You see, it's not liquid, it's not usually traded in the forex market. Okay, so as a beginner, even as an advanced trader, you should avoid these pairs. Totally avoid them because the cost of trading these pairs is too much and you might get into trouble trading them. Okay. So now let's talk about the types of traders. There are 4 main types of trading styles. Okay. We have the scalpers, we have the day traders, we have the swing traders, and then we have the position traders. Okay. So scalpers hold on to trades for a few seconds to a few minutes at most. Their main objective is to grab very small amounts of pips as many times as they can throughout the busiest times of the day. So they are like in and out traders, very fast. Day traders usually pick a side at the beginning of the day, acting on their bias, and then finish the day with either a profit or loss. These kind of traders do not they do not hold their trades overnight. So they basically wake up early in the morning, analyze the market, and then from the analysis they decide where they think the market is going to go throughout the day. Okay, so they open the positions probably in the morning and close out before the end of the day. So next are swing traders. So swing traders are for people that like to hold on to trades for several days to several weeks at a time. These types of traders can't monitor their charts throughout the day, so they dedicate a couple of hours analyzing the market every night to make sound trading decisions. So basically, this type of traders, they analyze the market probably during weekends, and when they take their trades, they let the trades run for days, sometimes even weeks. Okay, so most times these are traders who do not have time to be actively trading the market every day. So they just take one position and let it run for a very long time. So those are swing traders. Then lastly, we have position traders. So position traders are like swing traders, but even more advanced, as in they let trades run for even longer periods of time. Okay, so they let their trades run for several weeks, months, or even years. These traders know the fundamental themes will be the predominant factor when analyzing the market, and therefore they make their trading decisions based on them. So you normally won't find retail traders as position traders. Okay, it's mostly hedge funds, banks, institutions. These are the people who can go into this type of trading style because they deal with billions of dollars. okay, or millions of dollars. So they can afford to let their trades run for months or even years, because any profits they will make from that will be so much. Okay. So we have come to the end of this class. In the next class, we're going to be discussing terminologies in Forex. See you in the next one.